Alright, we're just going to walk through the top 5 charts of the week. This is a weekly free email that goes out to subscribers of the email list on the website. So starting off with number 1, this is Emerging Markets Sovereign CDS, or Sovereign Credit Default Swaps. Basically, well, first of all, just looking at this line, what is this black line? This black line is the median across, well, the median 5-year sovereign CDS premium across 14 different emerging market economies. So I use median because median gives you a better characterization of the sample that you're looking, or the population that you're looking at, rather than the average, which, you know, will be skewed by particularly, you know, significant outliers, like, you know, for example, if one country alone was going berserk, then, you know, that would tend to give you a bit of a skewed result here. Whereas the median will give you, you know, the median will be on the move when more countries are on the move, which is the situation right now. So there's probably about at least half of those countries, 14 countries, have moved by about, you know, at least 30 basis points upwards, and there's a few that have moved significantly more, such as Brazil, such as Turkey in particular, and another couple mentioned that in the article there. The blue line there is the 200-day moving average, and it's actually quite a useful sort of trigger point here. You can see that these last couple of instances when it broke above the 200-day moving average, that was basically a trigger point for some sort of wider issues there. So, you know, when it broke above there in 2015, took a while, but it eventually ended up blowing out quite significantly as the year blew on, and that actually flagged, because you see that there particular spike there, that was when we had that global market correction. So, you know, the warning sign was there, and that's why this one is so poignant. You know, you can see that it's breaking out again, and I think that a lot of this has been driven by the US dollar strength, which I think is going to continue. So one to keep a close eye on. And by the way, this comes from the newly released Global Cross Asset Market Monitor, which is the report that I've extended out to clients. And if you want to take a look at that, just get in touch. Number 2 is cyclicals versus defensives versus the PMI. The red line here, this is the cyclical sectors, so this is like technology, industrials, materials, and consumer discretionary. And against the defensives, which are, you know, your healthcare, staples, utilities, telecoms. And bottom line here, so it looks very stretched. So on the one hand, you can say, yeah, it looks a little bit too stretched, looks like it may have gone too far. But on the other hand, it's, you know, the fact that it is mapping pretty closely with the manufacturing PMI, it basically confirms that strength in the cyclical indicators that we've seen. So, you know, it's I guess a confirming indicator of the economic strength in the economic cycle. We get the next result for the PMIs. We get the market one tomorrow, I believe, and then we'll get the ISM at the end of next week. And you know, if it takes another leg down, then, you know, I think at that point this becomes a bearish divergence that you want to be positioning for. Number 3, stock market leverage. Now this one, if you're a regular viewer or reader or listener or watcher, this one you will have seen before. So it's the sum of net margin debt, net leveraged ETFs, and net speculative futures positioning, and it's standardized, or, you know, shown as a percentage of S&P 500 market cap. And quite interesting there, like, you know, when I showed it previously, I actually got a comment from one of the readers of the weekly email, and he's asking if I could show it as a percentage of market cap. So here you go. And yeah, if you have questions, if you want to see charts, you know, a different angle on a certain chart or something like that, then just, yeah, definitely get in touch. But the bottom line is it looked very significantly stretched, and I guess the line of reasoning, or the line of questioning that person had was, is it still stretched if you standardize it against market cap? And the answer is yes, it's actually still at a record high. So which is quite interesting. And if you look at that in dollar terms, that's $400 billion, about that roughly. And when you have that kind of build up in leverage, well, yeah, on the one hand, it shows that investors are pretty confident on the outlook. But on the other hand, the downside risk, or the negative aspect of it, is that, if these guys need to liquidate their positions in short order, then that can kick off a bit of a selling cascade, trigger a bit of a market crash. So it's something to be mindful of. The direct implications of that are, I guess whenever this gets stretched up to the upside, usually that's towards the end of the market cycle. But, I'll be looking at other catalysts for a potential for the next move in the markets. Number 4, a look at valuations. So this is the PE10, price divided by average earnings for the last 10 years. I'm showing this for USA, emerging markets, and developed markets excluding USA. And you can see there that the global equity market correction did drive a little bit of a reset in all of these, minor reset really. The conclusion that you could have made before the correction is still the same, and that is that the US by itself looks still towards the upper end of the range, still nothing like where it got to in the .com boom, but still, at the upper end of the range. But more so looking at the relative value. So, developed markets ex-US, so basically global ex-US is still looking notably cheaper on a relative basis. In emerging markets, there you can see they're trading at about a 20% discount to developed markets excluding US, and significant discount versus US there. But, what we talked about in the first chart there, if that US dollar strength really does continue and continues at a rapid pace, and with the unwind of quantitative tightening, every possibility that we might see cheaper valuations there. And wrapping up with another valuation, global equity valuation chart. This one is showing the breadth of valuation. And so anyone who's watching who's done any amount of technical analysis would be very familiar with market breadth measures, such as percentage of an index which is trading above its 200-day moving average or 50-day moving average, and any number of other ones like 52 2-week new highs minus new lows, etc. This one shows you in the bright red line the percentage of countries, and I think it was 40 something, maybe 47 countries here, where their forward PE ratio is trading at least half a standard deviation greater than average, so we call that maybe mildly expensive. And in the darker red line, it's the proportion of countries where their forward PE ratio is trading at least one standard deviation beyond the long-term average, so you'd call that expensive. You call that the hurdle for expensiveness. The moment it gets an equity market gets at least one standard deviation greater than its long-term average on valuation, then that you tend to call that overvaluation. So it's basically, the higher these lines are, the more countries across the world are overvalued on these two criteria. You can see there when it's moved up, particularly at the end of the .com boom, where it was very high. So you can see there that the majority of countries across the world were trading expensive, and we saw it creep up relatively high there also prior to the crisis, and actually also just when the market peaked in 2015 prior to the twin corrections then. And it was also flagging, this is what I was talking about in the monthly report last year, about how high this one is getting, and you know, it did actually flag that correction there, and now it's come back a bit. You know, the question is, I suppose, is whether that's enough of a reset to, before market goes onwards and upwards. So it's definitely one to think about. That one actually came from the 10 charts to watch for 2018. I highly recommend that you check that article out. It's pretty good one, pretty good selection of charts there actually, and you know, quite a few of them are actually proven quite prophetic as the year has evolved or progressed. Yeah, and if you want to receive this email, I will put a link in the YouTube video description. Otherwise, if you've got any questions, comments, complaints, feedback, just put them in the section below, and be sure to subscribe to the YouTube channel so that you don't miss out on any future updates. And I've got some interesting plans for quite a few more videos coming up, so definitely stay tuned.